Hi, it's Professor Mike, and we're talking Chapter 13, the overall audit strategy and audit program. So, the audit program is really the list of tests that you're going to do, both in controls and substantive tests, for each assertion within each line item on the financial statements. So, if you think about cash, cash has assertions, which we've learned about in the past: completeness, existence, accuracy, excuse me, valuation, ownership, presentation, right? And each of those assertions must be addressed in your audit work. Based on the risk that you have with each of those assertions, you will do more or less procedures. For example, it's relatively not very risky that people would not tell you about cash they have, right? So completeness is a lower risk, so you need to spend less time on looking for unrecorded cash than you do on verifying that the cash that the company says is in its financial statements is actually there and is theirs. So that's where you're going to get detailed steps. This also organizes the process and allows managers and partners and and in a bad case attorneys to know what you did and what your conclusions were. So audit programs are kind of your roadmap to what you're going to do from test work standpoint, and making sure that you did enough test work to support the audit opinion. Okay, so there's a number of different tests that are used to determine where financial statements are fairly stated, and the ultimately the we've talked a number of times throughout the semester about risk assessment. Everything goes back to risk assessment, right? Your audit risk, your inherent risk, your control risk, your detection risk, your overall risk of accepting the client. All these things are about risk management. Just as you risk manage how much time you're going to study for my quiz, you're going to risk manage as an audit partner, hopefully someday, how much effort you put into testing different parts of the financial statements of a client, or your willingness to accept or retain a client, right? Because they may present a significant risk to the company, to the firm, that you're not willing to take. So we use risk assessments to identify whether we have risk due to fraud or error, we don't care which, and design tests to assess those risks. And then the other tests actually, provide are done for audit procedures to address the risks that you've assessed, right? So the tests are test of controls to see if the company's internal controls are effective. We're only going to do these in a regular audit if we're going to reduce our substantive test work because we're going to plan to rely on internal controls. We could test internal controls and find that they're ineffective, in which case we're going to have to increase our substantive work. Economically, what happens in that case is that you go to the client and you say, okay, my fee was based on relying on your internal controls. Your internal controls were not effective. Therefore, I'm going to have to do more work than I plan to do, and therefore, it's going to result in a higher audit fee. Those are tough discussions because one, the client's going to get defensive because they're going to think their controls work perfectly. So you've got to have documentation and evidence to show them that they're not. Two, it's probably going to result in a material weakness or significant deficiency letter, which is going to reflect poorly on management of the company with the audit committee. And three, it's going to cost them more for an audit, and most people don't see an audit as as something they want to spend a ton of money on. So the more money they have to spend on an audit, the more painful it is to them, and they don't perceive a ton of value from audits, frankly. And so it's more of a compliance thing, like doing your tax return, that they know they have to do. And if you're trying to talk them into paying more for an audit, you've got to have a really good reason. So this is where this is where your audit plan really has to be well thought out, and that has to link to the business objectives of the accounting firm as well. And then the substantive test of transactions, whether all the transaction-related objectives have been satisfied for each class of transactions. So, there'll be analytical procedures and there'll be actual tests of details of balances. So analytical procedures are looking at financial ratios, looking at non-financial data, relating it to financial ratios, all different types of things. And then tests of details of balances is actually looking at documentation or sending confirmations to third parties or physically observing inventory, all those things. And you look at the balance sheet and the income statement, including related disclosures in testing balances. Now, one thing I'll point out in your textbook is they've identified testing balances of the income statement as one of the items, and really income statement gets tested throughout the year. It happens throughout the year. It gets tested throughout the year. The balance sheet is tested as of the date that you're opining on. So if you're December 31st year end, you have to do test work as of December 31st. You may do interim test work earlier on to get assurance about the financial statements and then do very limited test work at December 31st. This happens a lot with your bigger public companies, but on smaller companies, you're probably just going to do all of your field work based on the December 31st balances. Your income statement, it's not something that happens at a point in time or that you look at as a point in time like a balance sheet. It has happened throughout the reporting period, and so you've got to look at different transactions throughout the reporting period to ascertain that revenue was appropriate. Obviously, audit data analytics, our technologies are increasing in use because that's really important, and they can be used in any of the 5 types of tests. So again, the tests are how they relate to the audit risk model, right? Tests of controls help you substantiate your assessment of control risk or not. By testing transactions, you can get both evidence of control risk and evidence of for detection risk. A bank reconciliation conducted at year end can provide you information about controls as well as the balance at the end of the fiscal year. But bank reconciliations throughout the year provide you information about control risk, less about the December 31st balance. And then substantive analytical procedures and test of details of balances, it form the basis for your substantive procedures, which then reduce your plan detection risk. Okay? So again, all this comes back to the audit risk model, and that's why I keep pounding that model into you. So let's talk about the cycles, right? The reason that we think about these in cycles is that from a system standpoint, often these systems will be implemented based on transaction cycles because that's the easiest way to think about it, right? When you look at what's called order to cash, which is the sales and collection cycle, what you really want to understand from a system is how an order is generated from a customer. And oftentimes you want to go even before that. Like, how do you get a lead, a sales lead? How does that lead get through the sales pipeline? How do you send a quote to a customer? How does that customer accept the quote? When they accept the quote, is it binding legally, or do you have to enter into an agreement or series of agreements in order to make that quote legally binding, right? Do they issue purchase orders? Do they not? All these types of things, when we talk about revenue recognition, these are extremely important. So All these things work together to go from um, the sales journal, the income statement, to accounts receivable, right? Uh, you know, balance sheet account to cash receipts, which are debits and cash, right? So you've got your T accounts here. In addition, there's a bunch of other transactions that could be involved in here, right? Sales returns and allowances, price protection, all these types of things could be involved. Sales adjustments, discounts. Um, you know, these things could um, all be part of this transaction flow. But this is a simplified transaction flow and a good way to think about things. Okay, there are really two styles of audits. Um, One is this transaction flow methodology. The other is a balance sheet audit with the income statement falling out of the balance sheet audit, right? KPMG, when I was there, tended to use the balance sheet audit approach. Other firms use the cycle approach. I'm teaching you the cycle approach because I think you'll see it in systems implementations, and given the reliance on information technology and the flow of different systems between each other, I think the cycle approach is very helpful. But I'm happy to talk you through the balance sheet approach as well. Okay, so audit data analytics again impacts all these different types of tests, including choosing items. So selecting which types of items to test, right? Um, you know, you want to think about how available the evidence is, what's the cost of each test, and how good the internal controls are, and then what are the inherent risks, right? Um, when you think about calculating a sample size, the things that are going to influence your sample size are the amount of errors you expect, because if you do a statistical sample and you expect a lot of errors, then you've got to significantly increase your sample size. Or if you have a small sample size and you expect a lot of errors, you're going to get a lot of errors, and that's going to cause you to have a too large an expected misstatement based on the results of the sample. So there's a bunch of factors that you're going to look at when you're calculating your sample size. So the availability of the evidence, right? Um, you know, what can you do? Uh, can you confirm? Can you physically view it, right? If you can't physically view an item, then you've got to have another way to do it, right? What if investment securities are held by a custodian? Are you going to go view them? If you're doing a bank and they've got $4 billion in investment assets held by a third party, you're not going to go view and add up the $4 billion, right? It's probably all electronically kept at this point. So therefore, there's nothing to go view. What you have to do is go and confirm with the third party that they, in fact, have on account for you, for their client, the $4 billion of investments and certain characteristics about those investments. The cost of doing procedures, right? It may be that confirming something with a third party is a little less reliable, but putting you on a plane to go inspect a physical plant in in uh, let's say the UK right now, where they're on COVID lockdown for a month, is not a low cost or low risk item. So what you'd rather do is have a third party, either a local accounting firm, somebody else, or somebody who's done work for them, confirm that the physical facility is there and is theirs, right? Um, there's a number of different things that you have to think about, but this is basically audit efficiency, right? Um, and then what can you do to avoid cost, right? Analytical procedures are you know, the least costly, right? Um, down to tests of details of balances are most costly, right? So the more analytical procedures, the more you can test controls, the cheaper your audit is. And remember, the cheaper your audit is, as long as it provides the audit partner enough evidence so that they can issue an opinion on the financial statements. The financial statements are not materially misstated, right? That they're materially correct. Uh, then then they're able to afford the wine in their wine cellar. If you spend too much time doing detailed tests of balances and tests of transactions, then the cost of the audit's going to go up, and they're going to be buying $2 chuck for their wine cellar. Do you think they're going to be happy? No. So you want to get them just enough evidence, but not too much, so that they can issue the opinion. That's what they're planning on doing. So you can see in this chart, the evidentiary mix, right? The less you do substantively, the more controls you're going to have to rely on, and therefore test controls. So you want to mix your evidence and test controls to reduce your substantive procedures. Now, what Todd was talking about in some of these PCAOB reports is that the companies that were examined, the audits that were examined, some of the accounting firms actually did not do enough controls test work to establish that the controls were effective, right? They relied on controls. They said, we're going to reduce our substantive test work and rely on internal controls, but they didn't do enough test work on the controls to justify that reduced substantive test work. That's one of the areas that the PCAOB focuses on significantly. So the choice of evidence mix is extremely important because that is the thing that is going to give the audit partner the assurance that he or she has enough evidence to issue the opinion. And if you look at the mix that you might have, right? This is the E, the M, the S, the N, extensive, medium, small, no. You can convert these into numbers, right? And so for one audit, you have extensive test of controls. For audit 3, you have no test of controls. And therefore, audit 3, you're doing extensive testing of transactions and extensive testing of details and less substantive analytical procedures. Whereas in audit 1, where you're extensively testing controls, you're doing a small amount of detailed testing, whether it's substantive test of transactions or detailed test of balances, and extensive analytical procedures, right? So the combination of analytical procedures and effective controls probably gives you almost enough evidence, and in some accounts, probably enough evidence for the partner to be comfortable, right? And when we get into specific audit areas, I'll talk a little bit about this. So once you've got this framework, and again, you can put this into math and say, okay, extensive test of controls would be like 0.2, right? Some test of small amount of testing, might be, 0.8, right? No testing is 1. Medium might be 0.4 to 0.6. And you can just basically do a math formula that says, if I want to solve for 0.05, my inherent risk times my control risk times my detection risk has to equal 0.05. Therefore, I can play with these different variables and try and get back to 0.05 and see if it makes sense, right? Given a frame of extensive, medium, small, or none. Okay. So once you've done that assessment and decided, okay, I'm going to do, extensive controls tests, some analytical or extensive analytical procedures, and limited detailed tested balances and transactions, then you design your audit program. That's the list of procedures, right? And you're going to lay out specific procedures that you're going to do and tie those to individual assertions, okay? And as it says, each transaction cycle will be evaluated using separate sub-audit programs, right? So you'll have an overall program for the cycle, but then you'll have sub-programs for each individual account, possibly, right? Or major account in the financials, right? So you'd have a sales and collection cycle, but within that you'll have the procedures that you'll do on sales, you'll have the and revenue recognition, you'll have the procedures that you'll do on accounts receivable, you'll have the procedures you do on cash receipts, procedures you do on refunds, etc. Right? So the audit program is going to basically say, here's the test of controls that we're going to do, here's the substantive test of transactions that we're going to do, here's the analytical procedure specifically that we're going to do, and here's the detailed test of balances. So it's actually going to list procedures for you. And audit standards require you to have a written audit program. And a lot of this is software driven now. And when dinosaurs roamed the earth and I was doing audits, we had standard audit programs written on paper. Those audit programs are now computer generated and probably the result of asking a bunch of questions. We'll have Brian Outland here next week so he can talk about exactly how he reviews stuff and how audit programs are generated with Ernst & Young. But the audit procedures can be added or deleted as the auditor deems necessary, but that add-delete should also be reviewed by a manager and a partner to make sure that audit procedures aren't being omitted, right? Because that add or delete in a computer program or on a piece of paper will be questioned if there's ever, an examination of the PCAOB, an examination of your internal firm resources, an examination by a third-party accounting firm, or, God forbid, lawyers. So again, this is how you determine what tests you're going to do, right? You design your test of controls and substantive transactions, and ultimately you have the audit procedures, which then lead you to how do you calculate a sample size, determine what items to select, define the objective of the test, right? We'll talk about that later, and the timing of the test, right? Because the three variables you can change when gathering audit evidence are nature, timing, and extent, right? What you do, when you do it, and how much you do. So sample size is how much you do. Audit procedures are what you do. And timing is when you do it, right? And all those determine what the actual test is for and how many items you select, okay? And you apply the same thing to controls as you do to detailed transaction testing. And then when you test balances, you're going to have the same kind of methodology, right? You're going to figure out what other evidence you have gathered, and then that will determine how much you have to do from a sample size perspective in terms of things like confirming accounts receivable. Okay, balance-related objectives are ultimately the underpinning for your financial statements, right? So if you are opining on a March 31st set of financial statements, you are opining on the balance sheet as of that date, and then the income statement and the statements of stockholders' equity and cash flows and the notes thereto for the period ended as of March 31st. The test of balances gives you support for the balance sheet as of that date. And so that's why we talk about transaction-related audit objectives to balance sheet related or balance related audit objectives. So you need to know that you have enough evidence for the balance as of a date, and then the transaction related objectives are throughout the period being audited. Okay, and so even though you may test a bunch of transactions and you may get enough evidence on the transaction related audit objectives, you'll still need to do test of balances to meet balance sheet objectives, right? So rights and obligations, you need to know that as of the balance sheet date, we have the right to the cash that we say we have in the bank, right? We haven't pledged it for a loan. We haven't pledged assets for a loan, things like that. Are the assets realizable, right? Valuation. Are they going to be recoverable as of a date? And then presentation. As of March 31st, have we disclosed all the relevant financial factors that are required for each of the balance sheet line items? Okay, so ultimately the evidence comes down to what audit objectives you have, what type of tests you're going to do, what decisions you made based on the evidence, and what types of evidence you got, right? So in the planning and design phase, you'll do inquiries of the client, you'll do some inspection, things like that, and some analytical procedures. But as you move through the audit and perform tests of controls and transactions, you'll do inspection, observation, sampling, all the reperformance, recalculation to establish that controls are working, but also to establish that transaction tests are appropriate. And then when you're doing substantive analytical procedures and test of balances, you're going to be going to a different level, right? And remember, those are the tests of details of balances are the most expensive, right? This is where you're physically examining something. This is where you're sending out confirmations to third parties. This is where you're inspecting items. Again, inquiries to the client, reperformance, analytical procedures, and recalculation, those happen throughout the audit process, but really when you're getting down to balance information and verification of existence, accuracy, ownership, valuation, those require more hard evidence, and that's what you have to gather in the test of details of balances. Okay? And then when you're completing the audit, you're back to the analytical procedures. You're back to inspection. You're back to inquiries of the client because at that point, you should have satisfied all the objectives for evidence, and what you're doing is reviewing the financial statements to make sure that they make sense after you've gathered all that evidence, right? Because you have new evidence, you have information, and how you view that information is extremely important. And the evidence that you've gathered will give you new insight, okay? So again, the audit process comes back to, hey, we've got to plan the audit, we got to perform test of controls, then we'll perform substantive test of transactions, then we'll go to the analytical procedures and details of balances, right? Details of balances being the expensive part, and then we'll complete the audit, right? So timing of the tests, it can be anytime during the year, but the further away from the financial statement date you get earlier, the more evidence you need to get, right? Makes sense, right? If you're going to go audit accounts receivable as of June 30th for a 12/31 year end, which can happen, right? Then, or September 30th, you will need to increase your sample size. And then you will need to do other procedures to satisfy yourself that um, nothing changed between whenever you did the substantive work and December 31st. And you may do additional substantive work at December 31st, but it'll be much more limited, right? Obviously, procedures performed after the year end are better evidence because you've got the value of hindsight. So your sample sizes for a non-public client will probably be smaller, excuse me, because you're able to audit them if they don't have tight deadlines. You could be auditing a non-public client as of December 31st, sometime in March or April, because they don't need their audit right away. And so they will wait because their fees will go down because you're not going to be auditing them in January or February when you're auditing all your public clients who have very tight deadlines. And so they're willing to wait to get a lower fee as long as their bank or whoever requires the audit is willing to wait. And in that case, you're able to get more evidence inexpensively because you've got the 12/31 information and you're verifying the 12/31 information. You're not going in at September 30th, verifying September 30th, and then doing additional procedures. The downside is that when you're doing confirmations or things like that, and you're confirming in March to third parties, them having to go back to 12/31 can be painful, and some companies will not actually confirm information anymore because it presents them with a cost. So you need to consider all those factors in determining these procedures. Okay, so that's the background on test work. Now in the coming chapters, we're going to get into real test work and real substantive procedures for each specific audit cycle and audit area.